Good afternoon. You're watching ET Now with me, Aisha Faridi. I've got my colleague Ruchi Bhatia joining in from New Delhi, and this is indeed a special show wherein just minutes from now, the Reserve Bank of India will be releasing its decade's first monetary policy. Later on in the show, of course, we're going to be joined by top economists and bankers as well to dissect the impact and stance of the policy on the economy and, more importantly, you. The street, of course, is pricing in a status quo on policy. RBI Governor Shaktikanta Das's team may continue to keep an accommodative stance. However, the big question, Ruchi, I guess, remains is, will the Reserve Bank revise its inflation guidance higher? That, of course, is top on everyone's mind, and we've got a slew of experts joining in the next 1 hour to try and dissect and tell us what they're expecting from the policy. S.K. Ghosh, Group Chief Economic Advisor from SBI, Siddharth Sanyal, Chief Economist and Head Research at Bandhan Bank, Pranjal Bhandari from HSBC, R. Sivakumar, Head Fixed Income Axis Mutual Fund, and Nilesha, MD at Kotak AMC. But before anything else, let's take it across to Maithili Busirmat, Consulting Editor at ET Now, to tell us what the street is expecting from RBI's policy this time around, the first this decade.
This is going to be the Reserve Bank of India's last monetary policy announcement, the sixth for this financial year. Clearly, it's going to be a little easier for the MPC, simply because it now has a clearer idea of what the Finance Minister intends to do as far as the fiscal deficit is concerned. There is a mild easing, but not excessively so. At the same time, we've also seen inflation tick up in the month of December substantially to 7.35, though it is essentially driven by fruits and vegetables and food items, and it is expected to come down in a month or so. This will clearly be weighing with the MPC. The uncertainty on the oil front. So my sense, and I think almost everybody is agreed on this, that the MPC will opt for status quo and will also maintain its accommodative stance. So no great surprises expected. We hope to see some announcement as far as easing of credit flows is concerned. Possibly some, an announcement on, say, regulatory forbearance. But given the way the Reserve Bank has been behaving in the past few years, I do not think we can hope for that. But clearly, I think the issue of poor credit offtake is something that must weigh on the governor's mind. This is not the MPC's mandate, but it clearly is the Reserve Bank of India's mandate. Otherwise, we are not going to see growth kick off. And though the Reserve Bank can pat itself on inflation having been brought under control, it would have failed to do anything for growth. So I do hope we see something beyond the interest rate announcement and the policy stance announcement. Also, I think, given the announcement in the Finance Minister's speech about allowing non-residents to buy into government securities, maybe we can hope for some announcement on how much it will go up, what are the kind of securities, some announcement, but maybe it's a little early in the day. But as far as rates are concerned, stance is concerned, status quo, no great change. And also maybe something we can maybe hope on the GDP growth rate, because we saw the earlier estimate was 5, but after the revision that we saw in the first revised estimates, GDP growth rate should go up to 5.7. So we'll have to see what the RBI's take is on that as well.
All right, Maithili, let me also take it across to SK. Hi, SK, good morning. In your view, do you believe there is a possibility that the RBI could perhaps look at changing their inflation guidance as well, move from an accommodative to neutral policy if inflation continues to be more broad-based? Because so far, if the numbers that we saw the last time were to go by, we're really above the RBI's own comfort level.
No, I think the time has not come to move from accommodative to neutral, because inflation rate, even though it will possibly go up this month also, but I think is largely a factor of food inflation, even though there has been inflation which has been happening in non-food items also. But I think the RBI will see through this temporary phase, because as of now the inflation trajectory is likely to witness a decline from the second half of the current fiscal, and towards the end of the current calendar year the inflation rate could be significantly lower. So from that sense, the RBI could look through the cycle and possibly wait for an opportune moment to see any rate action if it requires to take so.
If I could get you in on the discussion as well. Inflation clearly has been a key factor which has been weighing down the RBI and MPC. Do you think it's a given that the inflation guidance would be revised upwards? Siddharth, my question's for you.
Hi. I think very clearly the inflation guidance would have to be revised upward a bit because at this moment we have seen quite a bit of upside surprise over the course of the last 3-4 monthly prints so far as this particular financial year is concerned. In case of the next financial year also, what we have seen in the global context, food inflation has started going up, and typically the correlation between global food inflation and Indian food inflation is typically very, very high. So in that kind of a scenario, most probably the assumptions the RBI had been having in its October policy and in December policy, there is an indication that eventually inflation trajectory can be slightly higher. But having said that, what is much more important is that over the course of the last 2-3 prints, the sharp upside surprise that we have faced with came due to just 1 or 2 commodities, and prices of those commodities have already started turning around. So in that kind of a scenario, even though global food prices are telling us a bit of upside pressure on a long-term basis, the relief we'll be getting from those commodities, for example vegetables like onions and all, that will possibly provide a much bigger cushion for the RBI eventually to turn slightly more comfortable. So our take is that the inflation forecast for the next few quarterly prints will be moving higher, but eventually it'll start looking a lot better than what the 7.4% latest print is suggesting us at the moment.
Right, let me take it across to Pranjal then. Pranjal, in your view, how is it going to be a trade-off between growth and inflation for the RBI? And do you believe there's going to be more space for easing come FY21?
Yeah, so look, it's of course as always the inflation and growth trade-off. You know, if we find in the middle of June that growth has improved compared to last year, but it's not taking off in a meaningful way, which basically means it's stabilizing at a sort of lowish level, and we find that inflation is coming down, perhaps not all the way down to sub 4%, but you know, still down, not as high as 7.5 where it is right now, then that combination could open up some space for easing. You know, at this point, we see space of about 25 basis points rate cut in June, but this is a very, very dynamic space, and we'll have to keep our eyes open for a lot of things, including, you know, the whole coronavirus spread, and then probably, you know, some little room could come up, but at this point, very, very hard to predict. So we're going with a 25 basis points rate cut in June.
Yeah, indeed, tough times these, and tricky times, might I say. But SK, you know, just taking that same point with you, it's going to be a tough one for the MPC this time around to balance growth as well as inflation. We know traditionally they've been inflation warriors, but how do you think this time around they'll be able to sort of balance the act?
No, I think there is, as Pranjal correctly pointed out, there is a white elephant in the room, which is the coronavirus. And if you actually look into the number of cases which has been discovered till yesterday, they are significantly higher in the span of, for example, in the span of 27 or 28 days till the virus was first detected in China. The number of cases is now 3.5 times more than the SARS virus that went on actually for 6 months. So the number of cases are spreading rapidly. It has already now spread to 29 countries, and that too within a span of 30 days, even though the fatality rate is on the lower side, and China is in a complete lockdown mode. So basically that is going to have a significant impact on the global growth. Possibly that could have an impact on the commodity prices as well, because the space which China could vacate may not be taken up by others. So we would be actually in a peculiar conundrum of possibly lower global growth and possibly a higher commodity inflation. So all these things taken together will make the life difficult for central bankers, and RBI is not going to be an exception. But my sense is that all this, and that could actually lead to some downside surprises to the global growth as well, and of course India will not be immune to such. So if I take all these factors into account, I think we are currently right now in an uncertain territory, and possibly the RBI should like to look through this cycle for a while.
Oh, Absolutely. Mr. Sanyal, if I can come to you, do you also believe that the overhang of coronavirus is going to also play on the RBI governor's mind? Everybody's been talking about how global growth could also be significantly impacted due to the outbreak of coronavirus. We still don't know whether there's what kind of medicines can one really use at a time like this. Given the fact that, the coronavirus issue has become a huge overhang, do you believe it's going to play on the governor's mind too?
Yes, it has to be, because at this juncture we know very little about how things will take shape over the course of the next few months. As Shoma rightly pointed out, there are instances of a few similar epidemic in the past decade or so, that which can provide us some kind of a reference point. But nevertheless, the future course for the global economy is significantly uncertain, and this is a time when, in general, the IMF and some of the other forecasters had been toning down their expectation, or toning down their expectation about the pace of recovery in 2020 and 2021. To add to the complication, now we are seeing a situation where the first 1 or 2 quarters can be impacted very severely because of this particular disease. And in that kind of a scenario, globally, central banks might have to turn a little more supportive on the growth front. But having said that, there can be supply disruptions, etc., also in case of a number of commodities. So it's a peculiar situation that way, and central banks would have to, or policymakers in general, would have to be a lot more patient and keep all their options open. So at this juncture, thus, we also think that, coming back to the Indian context and coming back to what Governor Das might do today, that it might actually be premature for him to jump into conclusion either direction, in one direction or other, and change the stance which he had been maintaining for a while. So our sense is very clearly that while the headline inflation print is very high, the governor might actually stay on hold, but at the same time, it's possibly premature to withdraw the accommodative stance as of now.
Ranjan, what would you be watching out for in terms of commentary from the governor today?
Well, as I said, the commentary around what they think are the pressures on both inflation and growth, what is long-lasting, what is temporary. So, the finer print on inflation and growth is one thing I'll be watching for. The second thing is any commentary they may have on fiscal, whether the fiscal numbers are achievable, or is there any risk, that such asset sales numbers may be a bit too ambitious, and what could the implication of that be. And third, a lot of market participants, for one, will want to see what is going to be the future of Operation Twist. Now, I'm not saying that the RBI will reveal their game plan quite clearly, but I think some of the questions will be asked to them on what they think, how long do they want to carry on the Operation Twist. So these are some of the other things I'll be looking out for.
Absolutely. SK, we so far haven't heard from the RBI on their rationale behind Operation Twist. A lot has been done so far in terms of RBI's own buying of bonds as well. Just help us understand, in terms of easing the yields, it did help, initially, but where from here? You expect the RBI to spell out the rationale today?
No, I don't expect the RBI to spell out the rationale, but RBI, hopefully, I think they will be active in the market in terms of a liquidity management. Liquidity is still plentiful in the system, but RBI will be comfortable with directing the yields, because now the budget has gone. So it has some direction of where the fiscal is going. So possibly it will be in the market to influence.
South, RBI has kept repo rate unchanged at 5.15%, so bang in line with what the market was expecting. We were expecting a status quo policy. What's going to be extremely critical this time, of course, is what does the RBI do in terms of an inflation guidance? Do they now revise it upwards, considering the last print for the previous month was well above the 7% mark? I think that's going to be most critical. The fact that they've kept the repo rates unchanged, that's at par with market market expectations as well. So it's a status quo policy. For the market, which went completely flat into the event, it's been a quiet day with a positive bias. The market has held its ground, 12,120 on the Nifty as we speak right now. They've raised the CPI forecast for the first half of FY21. They're going to continue the accommodative stance for as long as it takes. I'm just going to bring up that inflation guidance as well. They've raised the CPI forecast for the first half of FY21 to 5 to 5.4%. Again, much of the market was anticipating that the inflation guidance is going to be raised. I know one of our speakers was making the point that some of the commodity prices have cooled off, but the RBI has managed to raise its CPI forecast and kept the policy unchanged. Maithili, I would have to say this is at par with market expectations.
Well, absolutely. There's been no change, status quo, both as far as interest rates are concerned, as also as far as the accommodative stance is concerned. What is surprising is that GDP estimate for this year, that the current fiscal, has been retained at 5%, even though after the new revised estimates came out from CSO, technically speaking, it should have gone up to 5% for this fiscal. But RBI has chosen to keep it at 5% for this year. They bumped it up to 6% next year, but with a slower recovery than anticipated earlier. So the recovery is going to be slower, inflation is going to be higher, but by Q3 of next year, it's going to come down very sharply. So overall, RBI is not unduly concerned about inflation, and that really is a plus. So status quo on rates, status quo on stance, bump up in the GDP estimates as far as next year is concerned, this year at 5%. There is a revised liquidity framework, the implications of which will be a little, I would say, difficult for the market to understand immediately. We'll have to see how that works out. And as far as the incremental, there's some SOPs given to automobile, MSMEs and real estate, but it's a very marginal and very technical SOP. I think RBI could have been a little bit more generous on that score. As far as FPI flows, foreign portfolio flows are concerned, the numbers are very, very generous for this fiscal year. Likewise, in the case of ECB and RBI's reserves are at 471 billion. So overall, RBI doesn't seem unduly concerned, but on the global economy front, there still are some concerns.
Right. Maithili, could you just give us some more details? What are the SOPs which are announced for MSMEs and real estate that you just referred to?
Yeah, so the SOP really is that the incremental credit that is given to automobile, real estate and MSME, the incremental credit that is given over the outstanding as on the 31st of January will be deducted from the bank's total NDTL, demand and time liabilities, for the purposes of calculating the cash reserve ratio. So it is a very nominal kind of SOP that has been given, and that is also only till the end of July. So it's a very technical and very small SOP. I repeat, the incremental credit that is given by banks to auto, real estate and MSME over the outstanding as on 31st of January will be exempted for the purposes of CRR maintenance, but only till the end of July. So it's a very small, I would think, relatively meaningless SOP. If the RBI were to kind of give better SOPs, it could have lowered the risk weights for these loans. That would have been easier, more sensible. But I think the RBI often goes round its nose to touch its nose. So I think this is something that the RBI typically does, make things complicated when life can be quite simple. But would you agree with me, SK, or am I being the typical critical, skeptical journalist? SK Ghosh, Soumya?
Yeah, no, I think I was just looking into the policy. So they have made some changes. It's early to comment what will be the impact of the changes, but one thing which has been spelled out very clearly in the policy is the liquidity management framework, which was put out on the RBI website, and the RBI has actually adopted their targeting framework and has also emphasized that it will continue to maintain a framework which is conducive to the market. So apart from the changes which you mentioned in terms of the development and regulatory, there is also some point related to the restructuring of the MSME advances. So I think these are some of the incremental steps which the central bank has taken, and possibly a detailed amount of these regulatory policies could be unveiled in the April monetary policy announcement.
Okay, so Siddharth, now let me turn to you, Siddharth. What is your first take? Siddharth, Chief Economist of Bandhan Bank.
So it's a no surprise policy, and it possibly makes ample sense at this juncture to not to rock the boat, and that way it's a very prudent move. The other interesting thing here that there is a hint of continued support on the liquidity front, but most importantly what I would like to highlight that in terms of the stance, if you notice the language, they are very much emphasizing on the accommodative part. If I follow you correctly, you mentioned that they are talking about a stance of, they're talking about maintaining an accommodative stance as long as it is required, or a very similar phrase. I think that's very important, that even when we have seen a spell of high inflation, even if it is for 2-3 months, it's very clear the RBI is not panicking. It's taking a more holistic view and taking a more long-term view, and taking comfort from the fact that some of the commodity prices have already started softening, and they are giving a lot more weightage compared to the previous regime in the overall growth inflation dynamics, rather than looking only at the current inflation numbers. So that way it's very heartening. I think it's a very prudent stance to adopt at this juncture.
But Soumya, what point is there of maintaining an accommodative stance and reiterating that accommodative stance at a time when actually the liquidity is so surplus that RBI's liquidity absorption has in fact increased over the fortnights? So, does liquidity count if banks are not willing to lend at the end of the day? Soumya?
No, I think the willingness to lend is depending on the demand in the economy. So that basically is the most important function. So even if the primary part of the central bank is communication in terms of an effective liquidity management, which actually could aid transmission, and possibly an surplus liquidity management framework helps in the money market rates dropping to realistic levels. And my sense is that as of now, the transmission which has been, I think the important part is that keeping the liquidity in surplus mode and giving a no surprise to the market, because at the end of the day, everything, and the language of in terms of on a continuously on accommodative mode, I think that is more important in the policy rather than, so basically communication is more important in the policy than the policy itself, if I go through the entire policy.
But Siddharth, if that was the case and it's basically lack of demand, would it not have made more sense to kind of lower your risk weights for the loans to those sectors which you want to encourage? Automobile, real estate, MSMEs, rather than going through this convoluted way of incremental increase in credit, deduction for CRR? Would it not have made more sense to cut the risk weight for these? Siddharth?
You are right that just in terms of the immediate impact, a risk weight adjustment could have possibly generated more impact, and the current move is possibly a little small in terms of its immediate impact. But now, one important thing here, this particular policy is something related to this kind of policies can be adopted outside the purview of the MPC meeting also. So if something has not been done at this juncture, doesn't really mean that it necessarily would have to happen in another MPC meeting or or it can actually rather it can actually happen anytime in between also if the RBI decides to go for that. But having said that, I would tend to say that I'm not too sure that whether they will be offering that particular support to industry just now, because at this juncture there is a lot of concern on the part of banks also in terms of lending to this some of these segments. So even if the RBI offers this particular help, I'm not too sure whether there will be a dramatic turnaround immediately. So overall, as the RBI in my view is waiting for an opportune time to think about a somewhat lower rate maybe later during this year, which is very much a possibility once inflation starts coming down and growth numbers show only a modest uptick, most probably. It's possible that RBI might actually be striking a balance in terms of choosing some more opportunities.
Interrupt you there. I'll have to just interrupt you there, Siddharth. I'll have to just interrupt you there because we are also joined right now by Ashima Goel, former member of the Technical Advisory Committee and also Professor of Economics at IGIDR. Ashima, no surprises in the policy. Are you surprised at the revision of the liquidity framework? But apart from that, any changes that you're surprised about? The liquid incremental credit to certain sectors and the SOP that is given for CRR maintenance? Anything that surprises you, Ashima?
No, I think it is all as expected. And the liquidity changes suggest that they are continuing to support liquidity. And that is very important. We're seeing some impact in spreads decreasing through different sectors. So that should help some improvement in pass-through over the past 2 months. That should help. And also we are seeing an upward revision in the inflation forecasts as well as the growth forecasts. So there are some green shoots in growth. So it's a time to sort of watch that and continue to support it with surplus durable liquidity.
Right. Hi, Ashima. Good morning. I just want to understand from you the kind of SOPs that have come in for the real estate sector as well as MSME. There was a demand that one-time restructuring facility be given to the real estate loans, but the RBI has said that there will be no downgrade of commercial realty loans if the delay is genuine. They've also given a one-time recast of MSME's default loan up till December 31st. How are you looking at these two SOPs that are given, and do you believe this is going to ease the pain somewhat in these sectors?
Yeah, I think when I talk about liquidity, it's also important that it reaches, and NBFCs and so on were really instrumental in reaching liquidity to a lot of liquidity-starved sectors. So it's necessary to support their lending activities. And they seem to be doing this slowly. In a sense, the budget has also had some measures, and some of these continue those measures. So I think they are listening and responding, but it is a bit slower than what was necessary. Faster reaction would have helped, but like to say, half a loaf is better than no bread. So at least they're doing something, and that should help. I think one major step in the budget, for example, was that the measures are extended to smaller NBFCs. Those are the ones that were left out of the current liquidity schemes. So, and those are the ones who reach a lot of small borrowers.
That's a good bread loaf analogy, Ashima. We'll surely be quoting you time and again. And you know what? One can see that if you just stay with me for a second. We can see the market reaction. By the way, the market after a quiet start is at the day's highs. We're at 12,155. The breath is opened up. And I just want to quickly bring up some of these realty financiers. Be it an HDFC, which is holding up very well. Look at the kind of spike up that you're seeing on a Piramal Enterprises. That's at the day's highs. It's holding up about 5% right now. LIC Housing Finance, in fact, the entire HFC cluster, I know this is only a sentimental knee-jerk reaction. You really have to see whether this small window actually, benefits the stuck realty players or not. But you can see all these stocks, L&T Finance holding as well, spike up to the day's highs by about 4.25%. But Ashima, what is it that you made of the growth projections? Like Pranjal Bhandari from HSBC was earlier commenting that you've got this new white elephant, coronavirus. You don't know how long this is going to play out and what could be the repercussions. As of now, it's only China pulling up its stocks because, that's the motherland where it's erupted. But for FY21, the GDP growth has been revised to 6%.
No, I think that India, because of its size, is somewhat insulated. This is really going to hit the small open economies. India also, we are dependent on a lot of imported parts from China. Those industries are going to be hit. But I think it's an opportunity for domestic industry to pull up its socks and produce more. They're always complaining about competition from China. Now they should show that they can produce it. Sometimes these shocks, it might deliver a fillip to industry, actually. So it's not clear that it will necessarily be negative, in India at least.
Right. Ashima, the MPC statement also says that the committee has recognized that there is policy space available for future action. Do you believe this is, of course, giving the RBI some sort of a comfort level that while, yes, inflation is going to be high, but there are growth impulses, and that would mean that we will see some bit of RBI action maybe in the policies in the times to come in FY21?
If you think about flexible inflation targeting, if there's a negative output gap and inflation is below the long-term expected value, in the long term, and that is true, their projection is below 4% for H2. So then they have space, and if growth does not revive sufficiently going forward, inflation comes down, they definitely have space. They have space even today, but they want to be sure because they see the inflation forecast is very uncertain in the current situation. They want to watch food inflation for a couple of quarters maybe, but they have acknowledged they have space, and they have space even today if they want to use it.
What are you making of the revised liquidity management framework, which I can, see in the press release? You think that'll be enough?
I think one very, very positive feature of both the Ministry of Finance and the Reserve Bank currently is that they are really listening to markets. Earlier that was not there, and that led to a lot of liquidity squeeze and problems for the Indian economy. But now they are responding to concerns. And here, it's not that you're giving in to interest groups, but you're recognizing operational difficulties and where you can improve matters. So I think all these are responding to concerns expressed, learning from, what operational people are telling them. And as long as they continue doing that, there is positive correction, and it will help the economy. I think this is part of that, and they are small steps they take. So even if the size of the step is small, they will take future steps if necessary.
Great to join in, for you to join in and, give us your analysis on the policy. There you can see visuals from the RBI headquarters. The governor and his team, Shaktikanta Das, just gearing up to speak to the media. We'll, of course, cut across to that. But let me quickly take it across to Ajit Mittal, the Group ED at Indiabulls Group, joining us on the show right now. Ajit, hi, afternoon. A no downgrade if commercial realty loan, if the delay is genuine. Does life become easier for you?
Yeah, hi. This is really a very positive step forward. RBI and the government has responded to a long-standing, demand from the sector. It's not just the real estate sector; it's essentially real estate sector. Bulk of the funding comes from the NBFCs, HFCs. Of course, the banks also lend, but essentially it's the NBFCs, HFCs, which already is reeling under the onslaught of a very tight liquidity situation. So this step is definitely going to be a huge, breather. So in a sense, what they have done is to sort of give 1 year window, to